And here we can see very clearly that this inversion is now the longest in history below this green trend line, which is the break even point. And we have seen it like just before COVID, we quickly had a little inversion and then COVID hit. And obviously, we know what happened there. And then over here before 07, 08, it was inverted for a while before obviously we saw what happened in 07, 08, 09. And so the biggest thing to keep in mind here is that when you see an inversion like this, it tells you that a recession is coming. But historically, if you look at this chart, it's not until it uninverts that you actually get the recession. So about a year ago, 2 years ago, when the inversions began, people were always like, oh man, the yield curve is inverted. We're actually going to see a recession any day now. But in reality, it's when it uninverts is the trigger point for that recession.
Welcome back to Capital Cosm, guys. Today we got Gareth Soloway on the show. Gareth, thank you for coming on.
It's my pleasure. Thank you for having me.
It is our pleasure as well. But before we get started, I'd like to kind of remind you guys to hit that subscribe button if you haven't already. 88% of you guys who watch the show are not subscribed. Let's go ahead and flip that ratio around. It doesn't cost you a thing, and it takes less than a second. So hit that subscribe button. A little bit goes a long way. Gareth, you are... this is your maiden voyage on the show, so it's customary for me to ask, who are you? What got you started into trading, investing? Who is Gareth Soloway? What is your origin story?
Yeah, so thank you. So basically, it goes back 25 plus years, to be honest. I was in high school, grew up in kind of a lower middle income family. We didn't really have a lot of money. We barely went out to get dinner out anytime. And in high school, I was kind of looking at like, what would help me get into college, what would be good on the resume, if you will. And I came across the investment club, and it happened to be in the .com bubble. And so I kind of played around with some fake money at the time, and it was just incredible the moves that were happening in the .com stocks, much like meme stocks and meme cryptos and stuff like that. And honestly, as a kid that didn't have a lot of money, it was very addicting to think like, oh my gosh, this could actually be real. Like, imagine if it was real. Basically the dream was sold to me that this could be reality. And from that point on, I was one tracked. I was just like, I have to figure out how to trade. I went to school for economics, but honestly didn't use a whole lot of that. Once I got out, I worked at one job doing kind of insurance, financial planning. Hated it. Was on the phone doing cold calls and just not my thing. I wanted to be trading. And so after 1 year, I took $10,000 that I had saved and I started trading my own capital. And in the beginning, just like everyone, I got crushed. I mean, I lost nonstop. I did the wrong thing at the wrong time, but I did start to learn from my mistakes. And I had to work 3 side jobs just to kind of put money back in my trading account. And over time, I started to learn about psychology, about charts, technical analysis, and slowly things developed, and I became a winning trader at that point. So that's the origin story. It's quite something, yeah.
Yeah. So how have you kind of evolved your strategies over time with like the introduction of algos, and like how do you get an edge over all of that?
Yeah, so the biggest thing is you're right. The more AI gets introduced into markets, the faster markets become. If you look at the markets back in the 1920s, all quotes were written on a chalkboard and updated maybe a couple times a day. That was just the way it was. And then as internet came on, people could trade from home. They could watch the quotes. More people got involved. And I'm sure it'll just get faster and faster. And so the biggest thing I've learned is that human psychology doesn't change. Fear is fear, greed is greed. It was 1,000 years ago. Fear was fear and greed was greed. And so that's the driving forces behind charting. And when you find these principles, these trend lines, it just has some sort of psychological basis for why charts make moves. And that hasn't changed even in the last 20, 25 years. And so I still use that same methodology. The discipline is the most important thing, is not to get kind of caught in the hype, the FOMO, if you will, and just really rely on chart levels, look for multiple factor levels of support and resistance, and just trade them. Look for quick moves in each direction and try to make money in the way that we do.
Cool. Well, let's just dive right into the economy then, or the markets. Let's look at the markets first. What are some broad strokes that you're seeing in regards to the markets lately? If you were kind of to give us your 35, 40,000 foot view of the markets.
Yeah, so the broad kind of feeling is that we are in a momentum driven market, much like when I first started in the internet bubble, if you will, is there's so much hype around, this narrative of AI, which is valid. I mean, there was a lot of hype around the internet, and the internet turned out to be life changing for us all. And so it makes a lot of sense that people would have that same emotional response now. But the one thing I do know is that bubbles are still created, even if there's a thesis and validity behind why it's happening. And so I do think this market is a market where we have 6 or 7 stocks, the mega caps that are driving the gains. We know that the equal weight S&P is actually barely positive on the year, while the S&P itself is up something like 17 or 18% on the year. And that's primarily because of these mega cap tech companies just performing so well. And the more they perform, the more people push money into them because they are the only things that are performing. And so this is how bubbles are created. You get an over allotment of capital into one small area. And at some point that will unwind, just like in the internet bubble, it kind of was the same thing. Everyone put money into the internet stocks and it drove them insanely to the upside. But ultimately, there was an unwind process. So I would just say that people need to be ready for that. It's not to say it's going to end today or tomorrow, but just be understanding that it's essentially musical chairs. And when the music stops, you don't want to be the last one holding on.
How do you get ready, though? Because I see it in my comments all the time. Whenever I have people calling for tops or the popping of a bubble, they'll say things along the lines of, "I've heard this for the last several years. Why, why should we keep going down this path?" So, what do you say to those people?
Yeah, and that's valid, right? I mean, I think, coming out of 2022, we had a bear market. In October of 2022, we saw the market start to see more liquidity from the Federal Reserve, even as they tighten rates. We saw government spending jumping precipitously, which creates additional liquidity and spending that drives the economy and drives the stock market as well. But you're right. I mean, in general, I've even been saying for the last 6 months that this market is very, very overbought, and it's continued to go higher, and it's higher again today. And so what I would say is this, is that literally you can still be long the market, but a smart investor continues to take some profits along the way. And so whether you divide your portfolio up into tenths or fifths, every X% you want to have a game plan for saying, okay, I'm aware this market is overdone. Let me just take a little bit off and put it in the side. And this way I have cash to deploy should we get a bigger pullback like in 2022. And I think it's all about planning, right? It's about putting yourself in a position where, listen, you may not have 100% in the market when it goes up another 5 or 10%, but what's that worth if the market drops 50%? Or what if we have another 2008, 2009 and it drops 66%? So there's a matter of analyzing the risk involved of being all in long, and even some people with leverage, versus having some on the sidelines where you can sleep better at night.
Yeah. So one key indicator of a recession or a market slowdown is the inversion of the yield curve, the 210 spread. I was watching one of your live streams earlier today, and you made mention of the fact that the yield curve has been inverted for the longest time in history. Kind of unpack that. What does that actually imply? What does that mean?
Yeah, and that's a big one here, and we'll show that now. So basically, the yield curve is a precursor to a recession. Historically, it's been basically dead on every single time. You can go back to even before the Great Depression, there was an inversion of the yield curve. And this chart here shows us since 1980. And what we know is that the more prolonged the yield curve inversion, where the 10-year yield is paying out less than the 2-year yield. And that's what the inversion means for those of you out there that may not understand. It's usually when you lock up money for a longer period of time, you demand a higher interest rate because you're locking your money up. You can't do anything with that money for X amount of years. And so, if you're putting your money away for 1 year, you're going to demand a lower interest rate because it'll be freed up in 1 year versus if you're locking your money away for 10 years. And so it's when that gets lopsided, where the 10-year is paying out less than the 1 year or the 2 year in this case, which is what's happening, that's a precursor that something's wrong in the system. And here we can see very clearly that this inversion is now the longest in history below this green trend line, which is the break-even point. And we have seen it, like just before COVID, we quickly had a little inversion, and then COVID hit. And obviously we know what happened there. And then over here before 07, 08, it was inverted for a while before obviously we saw what happened in 07, 08, 09. And so the biggest thing to keep in mind here is that when you see an inversion like this, it tells you that a recession is coming. But historically, if you look at this chart, it's not until it uninverts that you actually get the recession. So about a year ago, 2 years ago, when the inversions began, people were always like, oh man, the yield curve is inverted. We're actually going to see a recession any day now. But in reality, it's when it uninverts is the trigger point for that recession. And we haven't seen that yet. So in theory, we probably won't see a recession until the yield curve triggers and goes back above that flat line. But the key is this, is that a yield curve inversion like we have now, every time in history, it has signaled a coming recession. And the key is people say this time is different. I don't go by that methodology. I say that until proven otherwise, you have to go with what history has said to you over and over again.
Yeah, and if there's a quote by, and it goes along the lines of, history doesn't repeat, but it certainly does rhyme. That's a Mark Twain quote. What are some points in history that resonate with you the most that you can point your finger at and say, this is the most similar to what we're going through today? Is it
Yeah, and I think,
70s?
obviously I wasn't around in the 1920s, but the Roaring 20s seem very similar to what we've seen here. You had so much liquidity in the system back then. Loans were being given out, leverage was being used, the government was spending, et cetera, following World War I in the early 20s. And so there's a lot of similarities with that period as well. And then you go even up to before 2008 and 2009 with the loans that were being given out for housing at the time, and people were taking zero down payment type loans. Very similar to what's going on now. And I think the only thing is we're just seeing it in a greater fashion at this point. There's more intervention by the Fed. I know everyone's talked about how interest rates have gone up, but if you look at the underbelly of the system, the Fed, especially in March of 2023, they started actually having a loan program that was an emergency lending program for banks because banks were starting to fail. We remember Silicon Valley Bank and these other banks. And so the Fed actually had this loan where banks could borrow essentially unlimited amounts of money. And it was called an emergency lending program. And the key was that you didn't have to actually have an emergency to borrow the money. You could just borrow the money essentially for free. So banks were taking that money out and then pumping it into the system to make money off of it and make that spread. And so there's lots of this type of thing that are going on where you have government spending, creating massive liquidity and functional money in the system. We continue to see more and more kind of risk taking. Like if you look at crypto, and I'm a big fan of Bitcoin myself, but crypto itself is a great example of how people are saying, screw the fundamentals. Doesn't matter if there's real value there. If it's going up, I'm going to just jump on board. And that happened in 1928, 1929 before the crash, happened in 1999, 2000, happened in 07 into 08. All of this mentality of this greed of saying, hey, doesn't matter if there's real value. It's all about just getting in because prices will go up. And right now it's working, and it will continue to work until it doesn't. And then things get very nasty when everyone runs for the door at once.
Yeah, so you mentioned the Fed funds rate there for a second. Powell did come out earlier today, kind of hinting at rates, the fact that rates can't stay higher for much longer without effectively, he didn't say this, but I'm kind of paraphrasing, without something breaking. The question is, how much longer can they keep rates at this level? You're dealing with $30 trillion in sovereign debt. You're dealing, 150 trillion plus in unfunded liabilities. And would a measly 25 basis point rate cut actually, cut it? No pun intended. In this case, how much longer do you kind of see them going down this path?
Yeah, so you're right about that. There's in our current state as a country, as a globe, interest rates cannot be high or stay high for a long time because every country out there, whether it's Japan at 250% debt to GDP or the US at about 130% debt to GDP, there's no way for us to pay the interest on this debt. And even in the US, we're now at $1 trillion a year, the biggest budget line for debt or for interest payments. And so the only way to essentially do it is to monetize that debt off, which involves lowering interest rates, making it much cheaper to borrow money. And I think the Fed understands that. I mean, look at what's going on with the dollar yen. The yen is being crippled. It's collapsing before our eyes. Obviously, it takes a slow amount of time. It's a currency of a major country, but we're now at a point where Japan is having to intervene in their currency markets because they've created such issues from essentially having zero monetary policy or free money system or free money in the system for such a long time that it's now causing major issues for their currency. And I think this is the end game for a lot of currencies. And not so much because remember, currencies are versus each other. So the dollar goes up or down based on what the yen, the euro, the yuan, all these other currencies do. But it's more about the buying power in each individual country. Like I was just reading the other day that Japan now, you have this 26th month of real wages dropping, right? So again, people's buying power in Japan just keeps going down and down and down because of what their government and their central bank have done for years and years. And it's crippling their economy. There's no doubt about it. And it's kind of, to me, I look at Japan and I say, that's the writing on the wall for the United States. And it will ultimately end badly. And I think that's the big system here is at some point, this all comes crashing down and what's left in its wake. And honestly, I don't know at this point what's left in its wake, but it makes me want to buy a little Bitcoin, a little gold, a little of these other physical assets to just protect myself.
Interesting. So we'll talk about Bitcoin. We'll talk about gold in just a second, but I want to kind of stay on the topic of the economy and this recession. Any other metrics, measures that kind of point towards a recession down the pike, or are we simply in a recession now? Given the fact that by definition, recession is you won't know until after it hits you, right? It's a lagging definition. So what do you say to that? Like, are delinquencies up? Is like any other metrics that you would kind of like point your finger to say, this is telling us that a recession is near or actually in place right now?
Yeah, so I think that's a great point. Is you essentially have at least half the country in a recession already. Not only like you mentioned, 90-day delinquencies on credit cards are soaring. We're at the highest level since basically 08, 09. We're also seeing borrowing from 401ks that's spiking dramatically. And again, it's called a hardship loan when someone pulls money out of their 401k, because that's honestly the last thing you want to do is cause that, suffering for later on where you're taking money away from your retirement. But people are having to do it to stay in their homes. And it's telling you right there that things are not that good. We're also seeing situations where full employment or full-time jobs are actually shrinking. So we've seen these jobs numbers every month, 150 to 300,000 jobs created. But if you look at the underbelly of these numbers, a lot of these jobs that are being created are part-time jobs, and people are losing full-time jobs, but having to take multiple part-time jobs on to basically afford to live because of inflation. And so all of these factors are starting to add up, where if you're not someone who has a lot of money in the stock market, you're not doing so well in this economy because of inflation, because of the cost of all these goods, housing prices, rent prices. I mean, you name it, things have gotten really nasty out there. So I think there's two ways to look at it. Number one is that at least half the country feels like they're in a recession. And I think you have to say that most people are in that position. And then the other half is that you likely will see a recession later on, but it'll coincide with a correction in the stock market. I think the consumer that has a lot of investments, they're just looking at this and saying, wow, every month I'm gaining 5% in my portfolio, so I can go out and spend. And they're keeping the economy going at this point, these high-end consumers, but that won't last forever. At some point, it will trickle up to them. And once that stock market comes in a little bit, you will see a full-fledged recession in the cards and basically in the data. And so I think again, it's just noticing these little pivot points, looking at the underbelly of the data that a lot of mainstream media is not covering, U6 unemployment, all these different metrics, and you can see that we're on the course to a full-out recession. But I think it's important for us to recognize that a good chunk of the country is already in recession.
Right. So let's go ahead and dive right into the charts now. What are you seeing by way of gold? Price action in terms of gold.
Yeah, let me bring up my charts here so we can take a look at this. All right, so let's see what we have here. Bear with me. There we go. That's the gold chart.
Hey guys, quick pause. Are you looking for a new stock trading app or just want to diversify where you put your money? Maybe you want a plan B, a plan C when it comes to stock brokerage apps. Well, I've got a special offer for you. It's from Mumu, and you get a special 8.1% APY on uninvested cash. That's right, 8.1% APY. And if you deposit $100, then you get 5 free stocks. If you deposit $1,000, then you get 10 extra free stocks for a grand total of 15 free stocks potentially, depending on how much you deposit. This won't be here forever though, so be sure to claim your offer now. Link to that is down below. Mumu has all of the amenities of your typical stock trading app. 100 plus technical analysis and drawing tools, 0 commission, 6.8% margin rate, 0 equity option contract fee, and more. So check them out, link down below. Let's get back to the video.
All right. So what we have here on gold, and gold again had put in a topping tail over here. So we do see that this was a little sell signal after the monster move to the upside. We saw the breakout. Essentially, what this was a 4-year breakout, right? So if we take the high from 2020 and we drag a trend line across, notice how you kept on going up and hitting that line and getting rejected, hitting the line, rejected, hitting the line, rejected. Notice how this was the shallowest pullback because it was the one right before the breakout. Now, once we got up to this high, we kind of stalled out. We've been consolidating since. And consolidation means price digestion. So after a huge move, think about it like this. If you have a marathon runner runs a marathon, they can't just run another marathon right after. They need to rest. They need to refuel by eating. And that's what the chart of gold is doing right now. Now, just in the short term, we saw a little breakout here. My guess is we'll chop around a little bit more and then make a run at the highs. And I actually think we will break out. And I still think we're north of 2,500 by year end. So I continue to be in the camp that, like we talked about just a little while ago, there's no way for the world and the US to get out of monetary printing, right? So you have debt that has to be, you basically have to lower interest rates, which makes more money in the system, makes it more free. And you also have to get in a position where the government is going to have to probably stimulate during the next recession. That's the US debt going even higher. The Fed will expand their balance sheet again. That's essentially the debt going even higher. And so you want these physical assets that kind of trade in terms of US dollars. So if there's more dollars, then gold is a place to store your value or keep your value, as it should go up in response. So I'm loving the chart on gold, and I think we're getting ready for that next leg up soon.
What about silver?
Yeah, silver's an interesting one. It also is performing very well, much like gold, in that it pulled back after its recent run up to $32.50. It's broken up here. I still think it might need to consolidate down a little bit more. See these two lines right here? That's going to be good support around 29.50. But I'm in the camp that even though silver is somewhat an industrial metal, right? So it's used in a lot of production of things. So if the US economy weakens, that does take a little bite away from silver. But I still think the overpowering thought process that more people in the world and in the US are taking on, which is, how do I protect my money against reckless spending and kind of the past decades of reckless spending, if you will, and future spending? It's going to be silver. So if you look at retail investors, people that, let's say you don't have, $500,000, people that have a lot of money probably are buying gold. If you have a mid-level amount of money, you're probably looking at silver. It seems cheaper at $31 an ounce. You can buy a few hundred ounces of silver for a reasonable amount of money. That's where you're going to see a lot of the middle income, middle class moving in to protect their wealth. So I do think that you will see silver trade up as well, although it's a little murkier because of the industrial production side.
Do you look at the gold to silver ratio at all, or are there any other ratios that you look at? Because oftentimes, just really quick. I mean, oftentimes, you look at a chart like this, but it's priced in dollars, and the price of the dollar is a moving target. It's basically bottom left to top right. So how do you kind of control for that additional flow into the money supply?
Yeah, and that's a good question. So I don't often look at the gold silver ratio, but I will say it is useful at extremes. So at some point you get a big divergence in the gold move versus the silver move. And I do think that does give you an edge in trading and swing trading. But I think for me, when I'm playing the metals and I'm looking at the key levels. So number one, I'm looking at the technical points, the pullback levels, the supports, the resistance levels. But even more so, what just keeps me buying the dips into support is just that macro viewpoint that we know the end game here. And at some point, we're going to have a recession, whether it's this year, next year, or 5 years from now, there will be a point. And if the US government hasn't been able to control their spending during an expansion, which is when they should be paying off their debt, paying off our debt essentially, which is our U.S. national debt, then what are they going to do when we have a bad recession? Well, they're going to go back to their playbook of printing more money, which again just makes me want to be long gold, silver, and the rest of these. But I do think, again, for shorter term moves on disparities, gold and silver ratio absolutely makes sense.
Okay, so what about the master resource itself, often put, which is oil? Oil is derivative. It's basically embedded within almost everything that we know of as a society. So how is oil doing? Typically, when you're in a recession, oil comes down, right? So it's like,
Yes.
what's
Yes.
oil telling us now? What are some
Yeah, so
signals?
oil is telling us. You can see I have this chart annotated right here. I have a little written out resistance point here. And what I love about this, so number one is we were down here and we've seen a pretty impressive rally on oil. At first, I was confused by this. I said, well, why the heck is this happening? Why are we seeing oil rallying up when we're seeing the jobs data start to decline and get a little bit worse? We're seeing PMI data decline. Globally, we know China's still not really recovering yet. Europe is going through kind of a crazy crisis with what's going on in France. Yet oil was moving up. And I looked at the underbelly and I actually saw that there was a lot of hedge funds that were overly short oil. And one thing I've noticed is that when you have an over allocation on the hedge fund front, it's so much money that it usually has to unwind. And I think that's why we saw this recent move up on oil. However, we did rally into what I call a three-peat or a 3-point major resistance level. Notice these trend lines all converging. And that's where I really get excited. So I turned really bearish on oil between $83 and $84 a barrel. And so far it's starting to work out. So it seems like the shorts that were hedge fund shorts, they've kind of rebalanced themselves on this move up. And now you're allowing for the natural macroeconomic factors to take over, which is a slowing U.S. economy, a slow global growth economy. All of these factors should bring oil down. And I do have some supports. These are all just for swing trading, $80 down to $77 here, and then eventually $73. But I will say this is that if China's economy doesn't start to grow and the US slips into a recession, I would say oil has a shot of going into the $50 a barrel range. I would continue to be looking for further downside, even with bounces along the way on oil.
So I recently had Doomberg on the show, and he said that he thinks that there's a $40 premium to oil, a $40 war premium to oil, given everything that's going on around the world. How feasible? Like, do you subscribe to that view as well? Is or should we actually be seeing $40+ oil as opposed to $80+ oil? And do we just simply have that $40 premium because of what's going on in Ukraine and Russia, what's going on in the Middle East, et cetera?
Yeah, so that's a good question. And so I'm not sure if I agree with the $40 premium in oil. What I do think is that there's no doubt about it. If you go back to 2022, when the invasion occurred, we did see oil getting as high as about $130 a barrel. So it has come down significantly, partially because I think the U.S. produces so much oil. We're basically energy independent via oil now and natural gas. And so I think that's taken a lot of that war premium out. And you can even see this, when things flare up in the Middle East, there's barely, like, there might be a 5% move up in oil, but it's not the levels that you would have seen 20, 30 years ago when there was upheaval in the Middle East, right? So I do think that there's probably a small premium in there. I would put it more at around the $10 range. But either way, I think what trumps it all is probably the economic factors, right? So as long as the U.S. is able to be energy independent, then oil is going to mostly ignore these war factors out there. And we're going to look towards the macroeconomic data. And right now, to be fair, a lot of people have been bullish on oil because we've been told there's going to be a soft landing, there's going to be no landing, all these great things. I just don't buy it. And I don't buy it because, as we talked about before, if you look at the underbelly of the economic data, it's starting to deteriorate very, very quickly. We talked about the jobs numbers every month. I think this last month, what was it, 206,000 jobs added? Well, as a headline, you say, wow, that's a great number. We're still adding 200,000 jobs. And then when you look at the underbelly, you're seeing, U6, which is underemployed, spiking higher now, 7-point-something%. You're seeing that full-time jobs are coming down, part-time jobs are moving up. These are all signals that an underlying rot is in the system that's likely going to lead us to recession. And I think the market's slowly recognizing that now as we start to see oil come in.
Yeah. So what about natural gas? Natural gas took a big hit after the war. It's at a couple dollars, $2 and some change now. What do you make of natural gas's descent down?
Yeah, I mean, natural gas is one of the trickiest. I mean, they call it a widowmaker for a reason, trying to
Right.
trade it. And I do trade it. And I could tell you from experience, it makes you sweat very often. Even if you end up being right, it certainly goes in wild
How
moves.
do you trade it, if you don't mind me asking? Do you do
Yeah, so I
futures
use
or?
the UNG. Usually,
Okay,
UNG is kind of a long ETF for natural gas. So I don't trade the futures really, the commodity itself, but the natural gas ETF is one way I swing trade it.
gotcha.
But basically, what we do is we look for extremes into resistance, and you can see right up here when we topped out, we could draw this trend line right across, and you could see that it came right here and pulled back, and then it got another push up. And this is a classic M pattern, which is usually a bearish pattern. Notice this downsloping trend line from this pivot to this low pivot, and that's where we're getting the current bounce. But I actually still see a little bit more downside on natural gas back to about $2.15. But at 215, I would nibble as a swing trade. And I want to be clear on that for all your viewers. A lot of people would say, hey, are you going to hold it? I don't really hold these type of things because they're too volatile, but certainly as swing trading opportunities, I am in play here. And the trickier thing with natural gas too is its seasonality is an issue. You have to be aware of that as we get towards winter. Usually you see a spike up. And there's just a lot of other factors with a glut of natural gas out there that we do see. So in general, swing trading is great on this. I don't swing trade it quite as much, or at least buy and hold it as much as I do on oil trades.
Okay. Well, what about coal?
Coal? Oh my goodness. I honestly haven't even really charted it, to be honest, on coal, but I don't look at that as a major one. I'm actually
Okay.
looking at for an
Yeah, no
ETF, but I'm
worries.
not even seeing one.
Okay. So what about uranium?
URA. Let's look at URA, the global uranium ETF. So this is actually a very cool chart because we have what's called a classic channel, which is an upsloping parallel line where every time you get to the high end, you sell off. Notice 1, 2, and 3. And then every time you get to the low end, look at the bounces that take hold. Bounce, bounce, kissed it here, and then right here we're at the lows. Now, the only issue here is that uranium, well, I shouldn't say it's not even relevant to uranium, it's just the chart pattern itself, is that upsloping channels eventually break to the downside. What the problem is, you don't know where that's going to be. So when you look at your charts, you could say, okay, well, this could go all the way back up here, but then it's resistance, but eventually it will break to the downside. And for me, I'm a big longer term uranium fan. I think that in terms of energy independence and safer energy, uranium is probably a clear winner in the future. But for me, I can't play it until we get a bigger corrective move. And this may seem kind of crazy to a lot of people, but I love a retrace. Look at this wedge pattern right here. See the breakout? There's a tendency in technical analysis for charts to want to come back to the scene of the crime, which was the breakout. And that would be right here. So what I'm going to do is on this, I'm going to be very patient. If it comes back to $22 or so on the URA, that'll be where I buy in and I start to accumulate down in this lower range.
Yeah. So how do you play these commodities, Gareth? Like, do in the case of gold and silver, do you play GLD, the SLV? Do you play with the miners? In the case of oil, do you play with the oil producers, the oil service companies? What's kind of like your preferred vehicle?
Yeah,
How do you?
so my preferred vehicle for the commodities themselves, like for gold and silver, GLD, SLV. For uranium, it would be the URA. Sometimes URNM is a good one. If we bring that up, that's the Sprott Uranium Miners ETF. That can be played. It essentially has generally the same chart. Here's the URNM, and you can see that same lower trend line that we're just bouncing off of, which was a parallel line on the URA chart. And so, I do play the miners as well. The miners tend to be a lot more volatile. And so in general, what I'll do is I'll start when I have a good level on the metals, I'll start playing the metals themselves via the ETFs. And then if they get really lopsided, like if you see GDX get just absolutely annihilated, like it did down here, right? So once we had this big fall, it was down to this technical double bottom. That would be where I would step up. And play it to the long side right there. So these are the different kind of little techniques I use, but I certainly do use these ETFs. I mean, there's XHB for housing. The housing, I think that's the housing one. Let me just double check. XHB. Yep, that's the home builders ETF. By the way, I annotated this chart at one point. Look at this beautiful parallel channel.
Mm-hmm.
We just hit the higher end. You can see it already starting to come down. So what I would do in this situation, right, is that if this chart comes down and tags here, you would play it for a bounce. You would just simply buy it right off of that level because history tends to repeat. And you can see that trend line should work again. Now, eventually, will this break to the downside? Yes, upsloping channels break to the downside, but you still can get a quick bounce off that level before. You just don't want to stay around too long.
Right. Now, you alluded to Bitcoin. Bitcoin's been going through quite a bit of a correction lately. What do you make of Bitcoin?
Yeah, Bitcoin has been something, I'll tell you. So my long-term thesis on Bitcoin is my same thesis as gold, is that I do think that more and more investors are looking for ways to protect against monetary policy and printing of money and global debt. And so I do like this as a long-term trade, but it doesn't mean that if the stock market corrects 20, 30%, that Bitcoin's somehow magically not going to go down. It still is a risk asset and still has to be kind of kept in mind here. So what I would just say here is that right now we just came down. We tagged a support level at 52,000 to 52,600. My guess is you're going to trade back up a little bit, back to about 60 to 61,000. But then I actually would expect another rollover to maybe 49,000 or so. Now, 49,000, I probably will start accumulating. And then if it does go lower, I'll continue to accumulate with that longer term thesis. So I think it's important also to recognize that as a trader and an investor, there's time frames, right? So me buying here, right? So I picked up some longer altcoins down in this range. I've already unloaded some of them for 10, 15% gains, and I'm still holding some for a move up that I would sell here. But once we get down into smart levels for like longer term opportunities on Bitcoin, that'll be where I start to actually slowly DCA in. And again, stressing that slowly aspect. Like I literally will probably buy like a 1/10 position at 49. And then if it goes to 45, I'll add another 1/10. And if it goes to 43, maybe another. And the idea is that in general, in panics, like if the stock market drops 20, 30%, I have no idea really which support level will hold on Bitcoin and be the bottom. All I can do is just slowly DCA in with my longer term thesis that Bitcoin will eventually bottom out and make a bigger move up.
Now, we have these 4-year cycles in Bitcoin called the halving cycles, and that's where you see it's like your big legs up. In 2017, you saw it. In 2021, you saw it. We're currently in the midst of that right now in the early stages. Are we tracking those past cycles, or are we underperforming at this moment?
So that's a good question. So I think at this stage you've made a new all-time high. So a lot of people would say that, hey, this is the bull cycle, so we're still in the midst of this next bull run. They may be right. The only difference is I don't think we've ever had a point where we had a new all-time high on Bitcoin and you didn't go up exponentially above that. And so as of now, that's a little deviation from previous bull markets where when you actually broke the previous high, you had the big move in 2017. And then in 2021, you had the big move up. Once we broke this high of 20,000, we went to obviously 69,000. And so in this situation, maybe it's just the beginning stages of that bull market. But so far, it hasn't followed suit. And the one thing I would just bring up to people is that in general, the Bitcoin life cycle, since it's been around, has been mostly in this monetary easing policy, right? Now you could say, okay, well, over the last year or two, we've seen a tightening. But in reality, again, if you look at the loan programs that the Fed has done, if you look at how much debt the US has been racking up, which is basically the same thing as stimulus, it's still been a pretty easy money environment, which is why inflation obviously took off to the upside. So I think that, again, I'm very curious to see what happens in the coming months to see if this bull phase does continue to play out, or do we see the stock market ruling the roost when we see a bigger correction in the S&P?
Okay, so I want to pivot over to the real estate market now for just very briefly. I saw a stat showing that real estate inventory in real estate has peaked all the way back up to 2007 levels, I want to say. What is your overall take on the real estate market? Is inventory still tight, or is it geographically dependent? The stat that I referred to was in regards to the South, which you saw a huge amount of inflow come in over the last 4 years.
Yeah, and that's the kicker here is that really, to be honest, I've said all the way along, and I still remember 6-12 months ago, people said, hey, listen, you're not going to see any sort of correction in real estate because the supply is way too small. People are just waiting for any sort of uptick, and as soon as people put more homes on the market, people are bidding in cash to take them over, and we're not seeing that anymore. There's no doubt about it. I think investors, or I should say buyers, home buyers, are now saying, whoa, economically, I'm not doing so well. It's hard to come up with a 20% or even 10% down payment. We're also seeing more and more sellers down here in Florida. Over in Texas is another place where we're now seeing inventory skyrocket, partially because home builders said, wow, everyone's moving to Florida and Texas. We got to build a ton of homes. Well, now people aren't buying those homes. And so that inventory is now sitting on the market. The other side, too, is especially here in Florida, the cost of home ownership is going insane. Not only are prices high, but if you're talking about getting insurance for your home due to hurricanes and natural disasters, the premiums are getting out of hand. Car insurance is going up. We've seen that being one of the most inflationary numbers recently as well. And so people are starting to say, holy cow, I can't afford to stay in my home, which is another reason why we've seen those 401k hardship withdrawals, people trying to stay in their homes and having to borrow from their 401ks. And so more and more, we're seeing this scenario where home values, we're seeing more and more cuts in prices in the South because people are starting to move away and there's just an overabundance of homes on the market. And I still think we're in store. And by the way, we're starting to see home prices really start to tumble in these southern areas. But keep in mind, we're not even in a recession yet where people are losing their jobs en masse. So think about that. What happens to home prices when we do have a recession, which again, I remind people, maybe it doesn't happen this year, but it is inevitable. At some point, we will have a recession.
Gotcha. So, Garrett, what I've been doing over the course of the last several interviews is I've been asking my guests to recommend a book or two for the audience. So I'm going to pose a question to you. What are some books or a book that you think the audience should read for the benefit of their investment education, financial education, et cetera?
So I would say that one of my favorite books, and this is one that goes to trading and psychology, is one called Reminiscences of a Stock Operator. It's the Jesse Livermore book. And basically, he was a trader in the 1920s into the 1930s. And multiple times in his career, he made the equivalent of as much money as Elon Musk has today. He lost it every single time by not being disciplined as a trader. And so when I read that book, when I was starting out, it was really a eye opener to say, wow, this guy was revered. He's called one of the best stock traders ever to exist. But even him, he still couldn't admit he was wrong in certain situations. And that's something that I struggle with constantly. I think that all of us as humans, we don't want to admit when we're wrong. But when you're investing, the faster you can admit it, the more money you keep in your pocket and can invest somewhere else that maybe you have a good trade. So it's actually an amazing read, and it's fascinating. And just, not to spoil it, but it got to the point where, during the Great Depression, he had so many shorts out there and was making so much money. The US government came to him and begged him to cover his shorts to kind of save the stock market. And he did do that. And he went on to make a lot more money. But interestingly enough, he actually committed suicide at the end of his life and died penniless because he lost it all. And it just, it's, I don't mean to be a morbid in that sense, but I think it's a lesson that all of us need to be aware of during these periods in the market, when greed is so apparent, when meme stocks are running up, and when we're seeing these Nvidias of the world just go parabolic. Just remember that it's much better to save yourself and save money. Like, even if you miss out on some of the run, protecting your assets is always the most important, even if you turn out to miss out on many trades.
Yeah, plenty of guests have also recommended his book, so we'll have that link down below, guys. Be sure to check it out. Also, another question that I've been asking my guests is to ask my next guest a question. So I'm going to pose this to you, Gareth. If there's a question you could ask my next guest, what would it be?
Do you have a name of that guest or no?
Yeah, it's Joe Brown from Heresy Financial.
Oh, good. All right. So I would ask, let me think here. I would ask him to break down the underlying data, that the recent economic data, like for instance, we're getting the CPI on Thursday, and kind of go into what we're seeing with the underbelly of some of these numbers, where that, I don't know if he'll know this, but where inflation is still bubbling up. And again, we've seen commodity prices start to bounce recently. Oil, obviously, we just looked at that chart earlier, starting to come back up. But I would love to know his ultimate interpretation of the economy. And is it as rosy as it's made out to be in the mainstream media and in other places, or is it really starting on that path towards recession?
I have a question from my previous guest.
Okay.
And it was from Brian Feroldi. And his question was,
What's your investing strategy and why?
So my investing strategy predominantly is to just use technical charts. And what I mean by that is we're talking cycle analysis, RSI divergences, trend lines, parallel channels we saw as well, wedge patterns. And the key is this, is that I've clearly learned that I'm a very poor stock picker when it comes to me just going with my personal emotion or what I think is going to happen. It's when I go to the charts that there's an unbiased view. A chart, when you look at a chart, it tells you a story and it doesn't have an ulterior motive. There's no narrative it's trying to spin. It is what it is. And when I look at the charts and I truly follow the charts, I always do much, much better in trading and I generally make money over time. And so I think that's the biggest thing is that I use technical analysis because it shuts down my emotional side if I just focus on that, and I'll do very, very well.
fantastic. So any parting thoughts before we wrap things up, Gareth? And also, where can people find you? Drop us your socials.
Yeah, sure. So really parting thoughts would just be very aware of, yes, momentum can carry this market higher. There will be a time where that music stops. And once it stops, you will see everyone rushing for the exit. And really, it could be very sudden and dramatic. And you just want to be prepared. Maybe it doesn't happen for a while, but it will happen eventually. And then just to my socials, you can find me on YouTube at Gareth Soloway or verifiedinvesting.com. And then also on Twitter at Gareth Soloway. Just watch out for fakes, guys. There's so many fakes out there that try to impersonate me. I'd never DM anyone or anything like that. So just make sure it's my actual verified account that you're following. And then just check us out at Verified Investing. We're data driven, all about charts, all about the good stuff.
Fantastic. We'll have the link to all of those down below, guys. So be sure to check them out. Also, if you like this video, be sure to give us a like. Subscribe to the channel if you haven't already. As mentioned before, 88% of you guys are not subscribed. Let's go ahead and change that, flip that ratio around. And if you really enjoyed this talk with Gareth, comment down below. Go, Gareth, go. Go, Gareth, go. And with that said, I will bid you adieu, guys. Until next time.